The common theme, I think, for a lot of the analysts who are making this call at the moment is that they want to buy it. So they'll say, like, you know, I expect the equity market to have a drawdown of maybe 10%, but ultimately I want to buy the dip. Heard the same thing from Mike Wilson of Morgan Stanley. Exactly the same. So the same thing from Goldman Sachs. They said, we anticipate a less favourable growth inflation mix in the second half, challenging the Goldilocks scenario. Still neutral and still moderately positive on stocks over a 12-month time horizon. I see that on repeat across Wall Street.
Yeah, how pessimistic can you get when ultimately you're talking about a drawdown? That's going to be a great opportunity. Please sell off so that we can buy it. It raises this question.
I mean, let's remember also that we also have a Fed that's planning to cut. The debate might be, do they cut in July or are they cutting in September? But the Fed is trying to be our friend. They are actually moving in a direction that tends to be risk supportive. And so, you know, having started as a strategist and having to live by trying to get the timing right, you know, I appreciate being a portfolio manager and getting to step a little bit away from the noise and be like, what's the main thing? And let's focus on the main thing. The direction remains, you know, a growing economy, growing earnings, and cash getting returned. Less cash probably gets returned to us as investors going forward when you think about the massive investment demands that we're starting to try to underwrite. And I think that's going to make things, you know, perhaps a bit trickier and where you have to deliver versus it would be nice if you delivered.
And a bias to reduce interest rates, as you say. Jack, appreciate your time. Jack Caffrey of JP Morgan. The Fed's still a friend of this market, and maybe the president gets his friend in the Federal Reserve next year. You're going to see even bigger rate cuts.
Yeah, which friend? I mean, I think that's going to ultimately be the question. Is it the Kevins? Scott seems like he's kind of on the outs just because he's doing a really good job running the world. I mean, ultimately, come on, it's almost like a downgrade for him at this point.
He doesn't sound interested, does he?
I mean, well, you could call it the Oval. No.
Listening to him talk about that situation, though, that list is longer than I thought it was, maybe. Regional Fed presidents, Fed governors in the mix.
Strategic ambiguity?
Don't know.
Yeah, I mean, is it trying to just... the biggest takeaway to me is they're not in a rush. And that means that they can consider all these potential other candidates rather than to rush into the Kevins or rush into the Waller. And that, I think, is the real big takeaway, which is in direct contrast with what we're hearing from President Trump.
Just calming things down.
As he always does.
For this morning, at least. Equity futures positive by 0.4% on the S&P with an update on stories worldwide. With your Bloomberg Brief, here's Yahara. Hey, Yahara.
Hi, John. The European Union is preparing to impose 30% tariffs on $117 billion worth of U.S. goods. The tariffs will be implemented if a deal is not reached by August 1st and the U.S. implements its levies. Sources telling us here at Bloomberg, U.S. industrial goods like Boeing aircraft, cars, and bourbon and whiskey would be subject to the tariffs. Meanwhile, Qatar says it will bid for the 2036 Summer Olympics. It wants to become the first Middle Eastern nation to host the events. Qatar is facing competition from other countries, including Turkey, Indonesia, and Chile. The nation says it is well positioned to hold the Olympics in its capital, Doha. And Starbucks opened free study rooms in some of its China stores to try and boost traffic. The company is taking a different approach in China where customers won't have to buy anything to use the spaces, unlike here in the U.S. Sources telling us here at Bloomberg, Starbucks China has also expanded its drinks menu to lure Gen Z customers. That's your Bloomberg Brief. John?
Hara, thank you. More from Yahara in about 30 minutes. Up next, the morning calls plus Aditya Bave of Bank of America on the path for interest rates. Live from New York. You're watching Bloomberg TV.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
We are making good progress with the 27 countries. We are the deficit nation. They're the surplus nation. So any kind of a escalation in trade problems will always hit them worse.
The Treasury Secretary, Scott Bessent, on the potential for an agreement between the United States and the European Union following the trade deal between the US and Japan, igniting this move in the equity market. This move worldwide. Big rally in Japan, rally here stateside, up by 0.4% on the S&P, on the Russell, up by 0.9. That's the price action. Let's get you some morning calls. First up, TD Cowen raising its price target on Capital One to 260, citing solid growth in its credit card portfolio. That stock is up by 2.6%. Your second call from B of A, raising its price target on Amazon to 265, citing Anthropic AI growth ahead of earnings. That stock is up by 0.5%. And finally, Mizuho lowering its price target on Texas Instruments to 200, noting its muted outlook due to auto and tariff headwinds. That stock is down by close to 10%. Let's stick with tariffs. GM and Nokia also reporting increased costs due to the levies. Aditya Bharve of Bank of America writing, with the stagflationary shock possibly extending into 26, it becomes more likely that the Fed will be frozen in place, consistent with our out-of-consensus call of no Fed cuts this year. Aditya joins us now for more. Aditya, good morning.
Thanks for having me.
Is that a dual mandate in conflict by the end of the year?
It could be. So there's interesting stories on both sides of the dual mandate. On the unemployment rate, the big question is how much of the slowdown that we're seeing in job growth is supply versus demand. And if you look at the U rate over the last year, it's been flat. If you look at the ratio of vacancies to unemployed workers, it's been flat. So that suggests that a lot of the slowdown is supply, which makes it less necessary for the Fed to respond. And on inflation, I think there's two issues, and those are the issues that we would take with Waller's view on inflation. One, underlying inflation, I think, is stuck at around 2.5%, not close to 2%. That's ex of tariffs. And two, there's a question about the persistence of the tariff shocks, especially the pass-through of tariffs, particularly as you get these continued kind of ratcheting up of tariff rates.
2 points there to address the dual mandate. Do you have a higher conviction view on one side versus the other?
That's a good question. I think probably higher conviction on inflation. The labor market is very much in flux right now.
At this point, can we really say that we have certainty and that we can start pricing in the actual effective tariff rates in a way that we didn't have the capability of doing, say, 2 weeks ago?
We certainly don't at this point, because we at least need to see how the 1st of August plays out. But even as you get past that, I think there are certainly risks that we could continue to see, threats of tariffs or actual implementation of tariffs that are a little bit higher than expected. I mean, after the 9th of April, we assumed that 10% was the baseline rate, but now higher rates are on the table. There's 15% or 19% as a baseline for many countries.
You know, you said that you have more conviction about inflation being higher on the backs of tariffs, but also some of the other influences in the economy. Is that okay? I mean, people talk about it like it's a negative, but maybe we need to have a higher inflation rate given the fact that we have a lot of debt. It used to be inflate ourselves out of that, right? That used to be the mantra, and we see that on a global basis in developed markets. Why isn't this actually the cure to a lot of those problems?
It could be. I don't think 3% inflation is disastrous for the economy, and I don't think 4.5% policy rates are disastrous for the economy either. It's just that the two go hand in hand.
Do the threats to independence right now make it harder to reduce interest rates?
That could be the case. I think most of the Fed is probably just focused on its job. And again, I mean, instead of thinking about that, I think it's easier to just think about the fundamentals. And I don't see the fundamentals on inflation right now supporting rate cuts. So the idea would be, okay, we had these April tariffs. There's views from the Fed, like New York Fed President Williams, saying just the April tariffs could continue to affect inflation into early next year. Now you have this additional round in August. When does that fully play out in prices? Is that the middle of next year? At what point do we stop saying this is a transitory shock?
Why wouldn't it be a transitory shock, even if it continues into next year? What's the time horizon for transitory, I guess, is the
exactly. That's the question, right? And if tariffs keep kind of ratcheting up over even a couple of years into the midterms, then when does transitory stop being transitory? Is it 2026, 2027? I don't know, right? And again, underlying inflation to us looks like it's around 2.5%. It's not 2%. So if the Fed wants to maintain its credibility, I think it makes sense to stay where they are right now.
You know, you talk about how you're not as concerned about the labor market. You're more concerned about the inflation aspect, and that's something that they should combat more. I'm talking about the Federal Reserve. I just wonder what you're looking at in particular. Is it the ramification from the One Big Beautiful Bill and the stimulus effects of that? Is it the Industrial Revolution 2.0, where you're seeing a huge capital expenditure influx in corporate America? What exactly gives you that faith that there will be that strength on an ongoing basis, even in the face of inflation?
Right, so I should clarify what I said about the labor market. Our view is that job growth is slowing down, but we see that more as a supply story rather than a demand story. So there is some slowdown there, and that'll affect labor income as well. But what makes us feel better just in the last few weeks is the pickup in consumer spending, because ultimately there's this chicken and egg relationship between job growth and spending. So if you look at the July data, well, June retail sales were somewhat strong. Maybe a lot of that was inflation. You look at July, you had a very good Prime Day, and air travel has really picked up in July as well. So the consumer seems to have rebounded a bit going into the third quarter.
You said something about the supply side of the story,
yep.
And I thought that it was really interesting. Pantheon Macroeconomics put out a piece challenging the idea that there was this huge exodus of immigrants, particularly illegal immigrants in this country. And they said the actual state-by-state data does not back this up. And in fact, in a lot of the areas that are most sensitive to this workforce, you are not seeing declines in the labor market. Are you seeing more evidence that there is actually that exodus that some people talk about, that really everyone's been surprised that the market's held up as well as it has?
So two things to say about that. I haven't seen the notes, so I can't comment on the details. But again, if you look at the bigger picture data, the best indicators of the balance between supply and demand in the labor market are the unemployment rate and the V by U ratios, vacancies to unemployed workers. And both of those have been flat for a year, even though job growth has been somewhat tepid. So that suggests a supply story, right? And then the other thing to keep track of is that some of these measures have recently been green-lighted by the court. So you could see a bigger slowdown starting even in the next jobs report.
This is the call for 25. Yep. No cuts.
Yep.
Have you established one for 26 yet?
Yes.
What is it now?
We think they'll cut by about 100 basis points next year, but there's a lot of risk around that number.
Just help
right?
me understand the 100.
Yep.
Where does the 100 come from? Is that because there's a new Fed chair?
That's part of the story.
So you believe it's just the individual. That's what matters here, not the economic backdrop.
It's part of the story, but I think by late 26, you're also going to have a little more confidence on inflation, right? So right now, the Fed is sitting there and thinking, okay, we really don't know. I mean, what they said in April was, let's get some clarity on the tariff picture, and then we can move. Going into the July meeting, they're not going to have that clarity because the April 1st deadline is 2 days later. I don't even know if they'll have clarity on the economic impact by the end of this year. But presumably in the second half of next year, they'll know more.
So transitory is 12 months.
It's going to
clear that up eventually.
I think that we have a good understanding. Transitory is the end of 2026, and then they can make a judgment.
Aditya, good to see you. Aditya Bava there, Bank of America. This is part of the call for next year. It's not just about the economics, it's about the politics. It's the individual that's chosen to lead the Federal Reserve.
So at this point, you can say that there is a political sheen to the Federal Reserve. You can make the argument there always has been. This isn't new, but it really shows how this is moving markets in a significant way and expectations even before Fed Chair Jay Powell departs.
I wonder if the president's conditioned by his last pick, which was Chairman Powell. That was the sensible pick at the time. Go with someone on the committee, elevate them, and whether that holds back the president from selecting Governor Waller at a time when a lot of people on Wall Street would like to see Governor Waller become the next Fed chair.
Well, evidently he's got some regional Fed presidents to choose from.
They?
So, you know, let's get our trees out and start thinking about that.
from the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Coming up in the next 30 minutes or so, don't miss this conversation. Anne-Marie catching up with the Commerce Secretary, Howard Lutnick, in Washington, D.C., following a trade agreement between the United States and China. A deal struck overnight that's unleashed quite a rally in Japan and a decent rally stateside too. From New York City this morning, good morning and welcome to the program. Equity futures positive by 0.4%, a 2-day winning streak into Wednesday, all-time highs. On the Nasdaq, up 0.1%. The next stop for this market, Alphabet and Tesla, after the closing bell. Check out fixed income, 2-year, 10-year, 30-year, 10-year bond yields falling for 5 consecutive sessions coming into today. Yields rising today by 2 basis points, 4.36 on a 30-year, up by a basis point or 2 to 4.93. Dragged higher by this, Japan. Japanese bond yields higher by 5 basis points at the long end of the curve, make it 8 basis points at the ultra long end of the curve. The conversation about Japanese debt, this isn't about the trade agreement, it's about the future of the Prime Minister and a messy debt auction.
There is a rumor, it has been reported by local media, that Prime Minister Shiba is going to resign, is going to step down after the disastrous election for him and his loss of popularity. Who gets in that seat? Is it somebody who wants to cut taxes in the face of higher debt spending and concerns about a slowdown? That is not what bond vigilantes want to hear, and they are protesting this morning.
Protesting this morning, and maybe that bleeds over to the United States at exactly the wrong time.
Well, this to me is really the question. Do we have a bond vigilante issue on our hand or don't we? Are they on the sidelines, or do people, actually really like the income and they're going to come into these developed markets regardless? And that is one of the big conundrums heading into 2026, the remainder of this year, simply because yields are high, but then people say, okay, but we want them. And we hear that from Bob Michael all the time.
Thinking of Bob, exactly. That's who was in my mind earlier this week. Bob Michael of JP Morgan Asset Management, who just talked about this wall of money coming into fixed income. That's the global debt market with 60 minutes until the opening bell. Let's get you some morning movers. We can catch up with Yahara for that. Hey, Yahara.
Hi, John. We start with the toy and game maker Hasbro. Shares are now down 4.4% because apparently good is not good enough. The company gave a strong second quarter and said that it's boosting its full year's outlook. The company cited ongoing cost cuts and saying that it had record results in its Wizards of the Coast unit, which I just learned makes the games like Dungeons and Dragons. Analysts say that the quarter beat even bullish expectations of JP Morgan, calling the updated forecast conservative, yet shares are still lower. Next up, we have the auto stocks. They are having a bit of a relief rally here after the U.S., of course, struck a trade deal with Japan with tariffs not as bad at 15%. But the reason Stellantis is rising so much, 6.5%, is it imports a significant portion of the vehicles it sells in the U.S. from overseas. And what this U.S.-Japan trade deal does is it provides some clarity for the automakers, and some analysts say it could be a blueprint for any EU-U.S. deal. And we're starting to see the knock-on effects from Texas Instruments' weak outlook. Take a look at ON Semiconductor, NXP, all falling since, like Texas Instruments, they make chips for for the auto and industrial sectors. The worry here is what Texas Instruments has to say, that it still sees no signs of recovery in the auto sector, and it doesn't know how much of a pull forward, as we've been talking about, due to tariffs contributed to those strong results it saw in the second quarter and what it means moving forward. John?
Yahara, thank you. I think a question this morning for the equity market. What do you believe in more? The sell-off in Texas Instruments or the rally in global automakers?
Put perfectly. Do you sort of hinge your bets on the ability to plan for the future, or the reality that in the near term, we've already brought forward so much of that demand? So it's going to be maybe tepid for the next 6 months.
Some interesting movers for you this morning. More interesting ones after the closing bell. We'll hear from Alphabet and we'll hear from Tesla. Let's turn back to fixed income. The US 10-year Treasury yield rising on weaker safe haven demand as US strikes a trade deal with Japan. Joining us now is Lisa Hornby of Schroders, who writes the following: the curve has moved a long way and could be due for a pause. Lisa, good morning.
Hi.
It's good to see you. That trade agreement with the US and Japan, is that good or bad for bonds?
That's an interesting question. By itself, I guess you could say it potentially maybe is bad for bonds. I mean, yields are moving up higher. I think the bigger picture is that yields in Japan are moving higher. And so we're in a global world. And I think you have to think about if yields elsewhere are moving higher, that potentially reduces the demand from overseas investors for U.S. fixed income. Now, I'll note everybody was super bearish on demand for U.S. fixed income a few months back. Nobody wanted anything in the U.S. We'd see a buyer strike. The tick data has showed and other data has showed that that's not happening. But sure, higher yields abroad potentially reduces some incremental demand for the U.S.
You took it to Japan, so let's stay there.
You took it to Japan.
The move in Japan, is that because of what we've seen with the trade agreement, or is that because of what might happen with the Japanese Prime Minister and what happened with the debt auction?
I think it's a combination of things. I think it also potentially moves policy back towards maybe a more hawkish position than it would have been outside of a trade deal. So I think the confluence of factors suggests bond yields in Japan can continue the rise that they were doing previous to this last couple of months.
There is this dynamic that seems to be evolving where investors are getting skittish about the unwillingness of governments to pay their debts. Mm-hmm. And we've seen this in the United Kingdom, we've seen this on the margins in the United States, and we certainly are seeing that in Japan. How far does that go, right? Because at a certain point, if people are getting income that they haven't gotten in the past decade, they're going to like it, akin to what Bob Michael of JP Morgan Asset Management keeps saying.
I mean, I was listening to your comments before, and I think this is an amazing time in bond markets, right? It's probably the first time, maybe not the first, the last couple of years, it's been exciting to be a fixed income manager because we have income, we have yield. You know, you can buy relatively safe, high quality assets and produce a significant amount of income over the next several years. You also have the potential for capital appreciation. Eventually, we'll enter a cutting cycle. I heard your previous guest, maybe it's next year, maybe it's at the end of this year, but at some point, rates will be coming down, and then you have capital appreciation on top of that. So I think it's an amazing environment. I'm less concerned about the inability to pay debts. I do think curves generally, longer term, are biased towards steepeners because there does need to be more term premium. Now, I think a good degree of that is reflected in the immediate present. I think a lot of people are positioned in curve steepeners. I think we've had a lot of the bad news with regards to deficits and how big they are. So I do think there could be a tactical pause there. But longer term, yes, I think you need to embed some higher inflation risk premium. I think you need to embed some.
Julian Emanuel was talking about for a moment that he wants to buy.
Buying the recovery to the slowdown we haven't had yet, which is always a confusing one anyway. Lisa Hornby, it's good to see you.
It's great to see you.
Thanks for dropping by. I appreciate it. Lisa Hornby there of Schroders. Let's get you an update on stories worldwide. We can do that with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. President Trump announced a trade deal with Japan. The agreement imposes a 15% tariff on imports and creates a $550 billion fund to make investments in the U.S. Japan also agreed to buy 100 Boeing aircraft, boost rice purchases, and increase defense spending with U.S. firms. Meanwhile, Microsoft is accusing Chinese state-sponsored hackers of exploiting flaws in its SharePoint software in a hacking campaign. China responding, saying the country opposes cybercrime, but also opposes smearing others without solid evidence. And Morgan Stanley is being investigated by the Financial Industry Regulatory Authority, known as FINRA, over its vetting of.
They have been very focused on cutting costs. Prior to tariffs, they sort of accelerated some cost cutting at the corporate level. They will be raising prices, I think, selectively on toys. They are also just going to not sell certain toys in the U.S. if it doesn't make financial sense to do so, if they can't raise the price and consumers would not buy it at that price. So they're sort of using a mixed strategy. They had predicted tariffs to cost $60 million to $180 million on an annual basis 3 months ago. They sort of dropped that impact closer to the $60 million side. That's because of the lower rate on the Chinese imports. They are working to diversify the supply chain, but that will take time. The goal of less than 40%, that's really by 2027. So in terms of this year, where their supply chain is, they're sort of locked in with that at the moment, and they kind of have to work with the price increases and sort of balancing where do I increase price and not hurt the demand even more.
All right, Lindsay, thank you so much. We appreciate your analysis there. Lindsay Dutch, she's a consumer hardlines senior retail analyst for Bloomberg Intelligence based down there in our Princeton, New Jersey campus. Talk to us about Hasbro, the toy maker. Had some really good numbers, had some good guidance, but there's still tariff concerns out there surrounding this industry as well as other stock trading off a little bit. Let's break out and talk to the markets broadly defined. We want to go to Tatiana Darrier, strategist for Markets Live. Tatiana, thanks for joining us here. I know you guys do what you guys call a Markets Pulse survey. Tell us what that survey is and what's it telling you these days?
Yeah, so we try to survey investors out there just to get their thoughts and a sense check on the market, from time to time. Sometimes we do it instantly or every other week.